Lifestrategy 100 and its fellow siblings in Lifestyle Strategy 80, 60, 40 and 20. They're some of Vanguard's most popular funds, and for very good reason. They're really solid products and are extremely well diversified with exposure to regions around the world. But they also come with an incredibly cheap price tag of just 0.22%. So in real terms, you're only paying £22 for every £10,000 you've invested over a year. It's not that surprising that I get asked about Lifestrategy 100 the most out of any fund on Vanguard. So today, let's do a deep dive on what Lifestrategy funds are, who they're for, and a few things that I think are worthwhile highlighting. I will even show you how to automate this process, meaning you don't have to do a single thing for about 40 to 50 years if you want to, other than keeping up with your direct debit, so stick around to find out how you can do that. So let's get the basics right first. What is the difference between Lifestrategy 100 all the way through to 20? Well, it's pretty simple. The numbers let you know what percentage of the fund is exposed to equities, so what portion is invested in stocks and shares. Equities are associated with high returns but come with high volatility and high risk. The remaining amount is made up of bonds, and bonds are associated with being safe and stable returns, though their returns are lower than equities over the long term. But why would you need one over the other? Well, it's all down to risk appetite. When you're in your 20s and you're 45 years off retirement, volatility isn't a problem. You have a long time to ride the waves of the market. If within 2 years of retirement, then the next recession could halve your pension or your savings in the blink of an eye, which at the time could cost you about $500,000. Don't know about you, but no thanks. I'd rather stick than twist. The idea is that your risk appetite will decline the closer you get to the age of retirement or when you ever want to cash out your investments. As a reminder, anything which has a low risk has an equally low return over a long time period, but anything which is high risk will have a higher return over a long time period. These funds are extremely logical, and hats off to the individuals that came up with these funds. If you're in your 20s and you're holding anything less than Lifestrategy 100, you're either minted and you're retiring shortly, or you're extremely risk adverse. But how do we draw the line of when to move from, say, Lifestrategy 60 to Lifestrategy 40? Well, there's no absolute, but let's take the average ranges that Vanguard gives, but then I'll do my best to put a date on it. Let's make the assumption that we're going to retire at 67. If you plan to retire earlier, like me, then I'm sure you're smart enough to adjust the numbers. Personally, if I haven't retired by 67, then I hope I'm at least driving the latest Lamborghini, whatever that's going to look like in the year 2057. Lifestrategy 100 is really for anyone who is over 15 years until retirement. Let's say you've got 20 years to go. So in our case, you're a youthful age of 47 or younger. I wonder if you're a grandparent yet. Lifestrategy 80 is for anyone around 15 years until retirement, so you're around the age of 52. Around this time, hopefully you've at least got past your midlife crisis. Lifestrategy 60 is basically 10 years to go, so you're 57, not a million miles off 60. Lifestrategy 40 is 5 years to go or more, let's call it 7 years, so you've just hit the age of 60. I wonder if you've got any white hairs yet. I'm just kidding, you've been getting them since you were 35. Then lastly, we've got Lifestrategy 20, so if you're within 3 to 5 years of retirement, so at this point, you're the age of 63. By the time I'm 63, I wonder if Dwayne "The Rock" Johnson's become President of the United States yet. So, the shorter the period to retirement, the less risk you can tolerate, meaning you need a larger exposure to bonds, which have a more guaranteed return, but have little risk. Now let's look at the real returns and the impact of the choices you're going to make. EnjoyLife.com did a great article looking at Lifestrategy funds, so I'm going to summarise here the findings they had, but feel free to check out more of the details directly. To demonstrate what this reduction in risk looks like in reality, here we have each of the funds with their annual average volatility. At the lower end, we have Lifestrategy 20. You can see that the volatility is a small 5%, but as you go through the funds, it grows and grows until you reach Lifestrategy 100, where the average annual volatility is nearly 16%, over triple what Lifestrategy 20 is. But if you're going to tolerate higher levels of volatility and risk, what are you going to get for it? Well, here we have a graph that shows you the annualised returns for each of these funds. It ranges from 10% on average for Lifestrategy 100, all the way through to just 6% for Lifestrategy 20. So you can see there's a sound correlation between the methodology of these products and the outcome. Remember, these are just averages though. I do have some data here which shows you the performance between 2015 until 2020. As you can see, Lifestrategy 20 initially outperformed the other funds due to a downturn in the market, but as soon as the market picked up, Lifestrategy 20 was left behind as the others raced ahead, as they had a far higher portion of their funds held within equities. So, what's actually contained in each of these funds? Well, you can think of these funds in having two halves made up of the same ingredients. On one side you have equities, which is made up of several Vanguard equity funds from around the world. Examples of these include the Vanguard FTSE UK All Shares Index, the Vanguard FTSE Developed World Index, and the Vanguard Japan Stock Index, but there are many others. In the bond portion, there are lots of funds such as global bonds, UK linked inflation bonds, and UK investment grade bonds, for example. In Lifestrategy 100, 13% of the fund is held within the S&P 500, but as the equities portion shrinks, so does the exposure to the S&P 500, meaning that in Lifestrategy 20, your exposure to the S&P 500 is only 2.6%. As you can see, both the equities and the bond portions are very well diversified. Diversification is only one part of it though. We need to understand the weightings of each of the diversifying components has. The most important part to look at, in my opinion, is the geographical breakdown, especially within equities. If we look at the detail, we can see that equities portions has a massive exposure to the US and the UK. The US makes up 45% and the UK makes up 21%. This means your portfolio is relying heavily on the performance of the UK and the US. Regarding the UK element, I discussed this further in another video I did where I compared three of the most popular global ETF funds on Vanguard. This is Lifestrategy 100, the Global All Cap, and the All World ETF. Feel free to open this video for later. I'll put a ribbon somewhere above my shoulder here. In that video, I give my opinion on what I like and dislike about all three to help you pick which is best for you. So what are the pros and cons of the Lifestrategy funds? In terms of pros, well, the first is you don't have to worry about managing the funds yourself. It's all done for you. And the second, the funds are already mapped out at what point you need to move from one to the other, so you don't have to continually reevaluate risk or anything like that. Again, it's all done for you. And lastly, all these funds have a very low expense ratio of just 0.22%, meaning the majority of your money is working really hard to grow and not being eaten into by any greedy active hedge fund manager. But what are the cons? Well, for a start, the equities part of these funds is highly dominated by the UK and the US. I don't necessarily have an issue with the level of exposure to the US, as they do carry a massive weighting in the global economy, but your exposure to the UK is extremely high. If you're looking for a more balanced portfolio globally, you might not as want a higher exposure as 21% to the UK. In reality, it only makes up about 4% of the global economy. One of the next cons would be that you can't adjust it yourself if you want to change your allocation based on your research or what you think is going to happen. So I guess you're either fully bought into the methodology of these funds or you're going to want to do it yourself. Overall though, I do think they are really great funds for people who don't have very much of an interest in investing. They do 90% of the heavy lifting and do it all for a very, very low fee. Like I promised at the start of the video, there is a way to automate the process a little bit further. These are called the Vanguard Target Retirement Funds. They follow the same concept and methodology as the Lifestrategy funds, but instead of numbers between 20 and 100 in the name, they have a year rounded to the nearest 5 years in the future. So to give you an example, we have the Target Retirement Funds 2020 and 2025, and they go all the way through to the Target Retirement Funds 2060 and 2065. If you're 25 years old right now and you want to retire around the age of 65, then the Target Retirement Fund for you would probably be the 2061. Right now, this fund has an allocation of 80% equities and 20% bonds, which I can't say I like personally, as I don't think there's any need for you to hold bonds at the age of 25. But saying that, I'm not a financial advisor. If you do want financial advice tailored to your specific situation, then please seek out somebody who's qualified to do so. Anyway, as you can see, as the funds get closer and closer to the year 2060, the portfolio will adjust over time and drift towards a portfolio which is 50% equities and 50% bonds. As you can tell by these funds, they are less extreme than the Lifestrategy funds. These funds always hold bonds at 20% and only drift to a maximum of 50%, and then the opposite with equities, where they hold a maximum of 80% equities, but that slips to 50% over time. Again, these are perfect for people who don't really have a big interest in investing and they don't want to sweat over the small details. Simply open an account, pay into it, and forget about it until you retire. So there you have it, my guide to Lifestrategy products. I personally don't invest into them, but if you do want to see what I invest into on Vanguard, then feel free to check out some of the other videos on my channel. I'm really transparent on what I invest into, why I invest into them, and how much I've got in there, which include my main portfolio, which is on Vanguard. If you've made it this far into the video, then a massive thank you from me. If you enjoyed this video and have an interest in investing, finance or income growth, then feel free to check out some of the videos on my channel. That's all for this video. See you in the next one.